Have you ever wondered how different asset classes work? Well, today, we're going to unravel this financial mystery. Asset classes, in the simplest terms, are groups of financial instruments that share similar characteristics and behave in a similar way in the marketplace. Think of them as different species in the financial ecosystem, each with its unique habits and habitats. There are several main types of asset classes that you might have heard of. These include stocks, which represent ownership in a company; bonds, essentially loans you give to companies or governments; cash, the most liquid of all assets; real estate or physical properties; commodities like gold or oil; and finally, alternative investments, a broad category that includes everything from fine art to cryptocurrency. Each of these asset classes has its own risk and reward profile, and they can behave very differently under various economic conditions. Now, let's dive deeper into each of these asset classes. First, we'll discuss stocks. Stocks, also known as equities, represent shares in the ownership of a company and constitute a claim on part of the company's assets and earnings. When you buy a stock, you're essentially buying a small piece of that company. Now, there's a reason why stocks are often the first thing that comes to mind when people talk about investments. They have the potential for high returns. Over the long term, stocks have historically outperformed other asset classes. But here's the catch. They also come with considerable risk. The value of a stock can go up and down, sometimes dramatically, based on a variety of factors including the company's performance, market trends, and the overall health of the economy. So, how do you make money from stocks? There are two main ways. The first is through dividends. Some companies distribute a portion of their earnings back to shareholders in the form of dividends. The second is through capital appreciation. If the company does well and its value increases, the price of your stock goes up. If you sell your stock for more than you bought it, you make a profit. But remember, the potential for returns comes with the potential for losses. If the company doesn't perform well, the value of your stock could decrease. So stocks can be a powerful investment, but they come with a certain level of risk. Scene script. Next, we'll take a look at bonds. Think of bonds as IOUs. They are essentially debt securities where you lend money to an entity, typically a corporation or a government. In return, the entity promises to pay you interest over a fixed period and return the principal amount, which is the original sum of money you lent, at the end of that period. This is why bonds are often referred to as fixed income securities. They provide a steady stream of income over time. Now, let's talk about the risk and reward aspect of bonds. Compared to stocks, bonds are generally considered to be a lower risk investment. This is because the interest payments and the return of the principal are contractually guaranteed, assuming the entity doesn't go bankrupt. And even in the case of bankruptcy, bondholders are often repaid before stockholders see a penny. However, with lower risk comes potentially lower returns. The interest payments from bonds are typically lower than the potential dividends or capital gains you could receive from investing in stocks. But remember, higher potential returns also mean higher potential losses. In short, bonds can be a great way to diversify your portfolio and add a layer of stability. They are especially appealing to more conservative investors who prioritize preserving capital and generating steady income over chasing high returns. Bonds offer a more stable investment, but with potentially lower returns. Now on to cash. Cash is the most liquid of all asset classes, meaning it can be quickly and readily converted into other forms of value without losing its inherent value. This includes not just the bills in your wallet, but also the money you have stashed away in checking accounts, savings accounts, and even certificates of deposit. The beauty of cash is its safety. It's a secure place to hold your funds, offering a level of stability that's unmatched by other asset classes. It's always there when you need it, ready to be accessed for immediate use. However, there's a flip side to the coin. Cash, while safe, is also subject to inflation. Over time, the value of cash can erode as the cost of goods and services increases. This is why keeping all your assets in cash can be a risky strategy in the long run, as it may not provide the growth potential that other asset classes can offer. Cash is a safe but potentially low-growth investment. Let's move on to real estate. When we talk about real estate as an asset class, we're referring to property. This can mean anything from a residential home where a family lives to a commercial building filled with offices or retail spaces. Investing in real estate can provide two main streams of income. First, there's rental income. When you own a property and lease it out to tenants, you can collect rent. This can offer a steady, predictable cash flow that can be particularly appealing to investors. The second way to make money from real estate is through appreciation. Over time, property values tend to increase, and if you sell a property for more than you paid for it, you've made a profit. This is known as capital appreciation. But like any investment, real estate comes with its own set of risks. Property values can go down as well as up, and there's always the possibility of a market downturn. Property damage, either from natural disasters or from tenants, can also be a financial risk. It's also worth noting that real estate requires active management. Whether it's dealing with tenants, handling repairs, or navigating zoning laws, there's a lot more to it than just collecting rent checks. Real estate can be a profitable investment, but it requires careful management. Finally, we'll cover commodities and alternative investments. Let's begin by understanding what commodities are. These are physical goods that hold value and are often integral to our daily lives. Think about oil that powers our cars, gold that we use in jewelry, or agricultural products like wheat and corn that make up our food supply. These are all examples of commodities, and investors can buy and sell them in the global marketplace. Now, onto alternative investments. This category is like the catch-all drawer of asset classes. It's where everything that doesn't fit into the other classes ends up. This can include a wide range of investments, from hedge funds and private equity to collectibles like art and vintage cars. The exciting part about commodities and alternative investments is the potential for high returns. Because these markets are often less regulated and less transparent than traditional asset classes, there is the potential for significant gains. However, this also means there is a high level of risk involved. These types of investments require a great deal of specialized knowledge and understanding. For example, to invest in oil, you need to understand global energy markets. And to invest in art, you must have a deep appreciation and understanding of art history and valuation. Commodities and alternative investments can offer high returns, but they require a high level of expertise and come with a high level of risk. We've covered a lot of ground today. It's been a whirlwind tour through the fascinating world of asset classes, and I hope you found it as enlightening as I have. We've explored the broad spectrum of investment opportunities, from stocks and bonds to cash, real estate, commodities, and alternative investments. Each of these asset classes plays a unique role in our financial universe. Stocks, with their potential for high returns and capital growth, are the daredevils of the investment world. They offer the exhilarating highs and lows of the market's roller coaster ride. Bonds, on the other hand, are the steady, reliable workhorses, providing predictable income and a cushion against the volatility of stocks. Cash, that old standby, offers liquidity and a safe harbor in stormy market conditions. Real estate is the tangible asset, a solid foundation in a world of intangible financial instruments. It provides income through rents, appreciation over time, and tax benefits. Commodities and alternative investments offer a different flavor, adding spice and variety to our investment buffet. They can provide a hedge against inflation and a counterbalance to traditional asset classes. Understanding these different asset classes is crucial when building a diversified portfolio. It's like creating a well-balanced meal. You wouldn't want to fill your plate with just one type of food, would you? Similarly, a diversified portfolio includes a mix of different asset classes to balance risk and return. Of course, this is just the tip of the iceberg. There's a whole universe of asset classes out there waiting to be explored. I encourage you to dive deeper, do your own research, and consult with a financial advisor. These professionals have the expertise and experience to guide you through the complex maze of investment options. Remember, investing is not a one-size-fits-all proposition. It's a personal journey, and the right mix of asset classes for you will depend on your individual goals, risk tolerance, and time horizon. With the right knowledge and advice, you can navigate the world of asset classes and make informed investment decisions.